This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day everyone, it's Liam, Garman and Juliet Helmke here, the team behind Smart Property Investment and the Smart Property Investment Show here at Momentum Media. And today we're going to be unpacking some of the hot news, the big news in property investment and some pretty important facts that you need to be aware of as you navigate your property investment journey. And Juliet, some pretty interesting information and data coming out on the property market in our big cities in Sydney and Melbourne, perhaps going backwards. Juliet, am I right in saying that?
Oh, it is very hard to say at the moment, Liam, because what we really have is a tale of very different stories across the capitals running at very different speeds. So the latest information that we have, which was a really great report this week out from CoreLogic, looked at what's happening, particularly in Sydney's market, where dwelling values dropped back 0.1% over the month of October, the first drop since January 2023. Now, we know 0.1%, that's not a huge fallback, but it is interesting that that is the first time that we have seen a drop in the city in quite some time, really.
What would that represent? Over 1.65 million. What would that represent? Almost $17,000. So it is a pretty observable decrease over just 1 month.
Absolutely. And just given the fact that we have been on a consistent state of rising prices across that city since that point of January 2023. We had a really sharp decrease over in the city in Sydney as a result of the RBA's rate tightening cycle. So we had 11 months where I believe that prices dropped back about 12% or something. Quite substantial. And then since that point, we've just seen upward and upward momentum. But it seems that that has come to an end, at least for a short period of time. And this is really quite different to what's happening in some of those middle-sized capitals. Brisbane is going strong. Perth is going strong. We're really still seeing that while volumes are rising there, they're coming off the back of a very low amount of volume, and people are hungry for properties there. Prices are still going up. Not so in Sydney, not so in Melbourne, as we have observed for a number of months now. So it's worth looking at what's happening in Sydney to create this change. Is it following on from what's happening in Melbourne? Is it running at its sort of own speed? And what CoreLogic have really said is that what they see in Sydney is a bit different to what's happening in Melbourne. And I'll get into that in a quick second. But in Sydney, we've seen, as across the country, a lot of listings come onto the market in spring, more than what we've often seen over the course of spring. I think it's 13% above the previous 5-year average.
Which is gobsmacking amount. That is a huge increase in volume.
It is. And you know what we're seeing? There have been years where people have been holding back. The RBA has been doing its thing. Interest rates have been a concern for vendors. Will I have the competition? Buyer behavior has in some ways been a little bit depressed, but now is the year where people are going, you know what? I've got to pull the trigger. And so I'm going to sell. So we've really seen those, spring is usually a busy season. We know that. But this year
Spring cleaning.
Yeah, absolutely. People are they're making way, they're making changes. So in Sydney, we've really seen a big rise in volumes, which is always going to shift that buyer-seller dynamic. It's always going to give buyers a little bit more leverage. We know that. But what is really interesting to see in Sydney is that, in fact, this drop has not been driven by the whole market. No, in fact, it was driven almost entirely by the upper quartile house values over the month. So that is the most expensive properties, and they dropped back by 0.6% over that period. Whereas, in fact, in the lower quartile, things were still rising. People were still seeing price gains over the cheaper properties in the city and into those medium ring as well. So what we're seeing is that there's that ceiling that's being reached there in those high value properties. Buyers there are sort of they're using their leverage, they have more choice, they are perhaps able to be a little more choosy and be able to sort of potentially wait a little bit longer. And that has really, it's interesting how dynamics even in a certain sector of the market can actually impact what we see as happening overall in the entire city. So some really interesting takeaways there this week to see Sydney kind of have that stagnating figure, while, as I mentioned, Brisbane, Perth, Adelaide, all still appearing to have, some hot gains happening over the month.
And that is interesting. So you have the more affordable is a very reasonable way of putting it, dwellings actually increased by 0.5%. So the primary driver, 0.6% fall in those houses in the upper quartile of value, which it's been reflected over the last 3 months, dropping 1.1%. It seems like there is an element of economic arbitrage happening here where the longevity of higher interest rates are pushing them a little bit too much above that affordability, and people are now selling and buying down, which is now putting pressure on those more affordable homes, which I think it's reasonable. We did expect this, and this has been something that's been on the horizon for a lot of property investors for a few years now, in terms of looking at the apartment market for investments. Given that your price of the average home is going up so high, you will have, say, pensioners downsizing. And that's not through cost of living. That's not through inflationary measures. That is, hey, I'm actually at that age where I can't look after an entire house. So you will have a whole cohort of people that will actually be buying down, which happens all the time in property. But then you also have that combined with people that are now buying down for economic reasons, that they can't afford their interest rate rises. You also have those people buying down for that economic arbitrage, which is saying that, well, yields in Sydney aren't necessarily great. I think it's reasonable that more often than not, property investors are buying in Sydney for a capital gains benefit, not for yields, not for necessarily a passive income. And those people that are seeing yields in some parts of Sydney just not keeping up with what they would expect from a property investment, that they're now buying down into peri-urban areas where you might get a better yield, which is now pushing those prices up a little bit more. Now, Juliet, there's been a little bit of speculation about the boom. Do we expect there to be a housing boom in 2025? Will it continue? Will it peter off? What's the data saying?
Well, it's quite interesting because, what we have been hearing is that there is an expectation that when the RBA moves to make a rate cut, it will incentivize a lot of buyers out there to make their own moves. Just even if that percentage doesn't change things materially for them, it's a mental block, isn't it, for people to feel like, oh, it's going, it's on a downward trajectory. It gives them this level of sort of confidence. So we do expect, a lot of economists are saying that they expect to see buyer activity quite high next year. And, that's an important thing to note in general, is that the point that you just made, Liam, buyers are still out there. What we see happening in Sydney is actually just some sort of concentrating in some different markets. And it's what we see in the investment landscape, sort of the investment for rental landscape as well, is that some of the reasons why certain cities are running quite hot, Perth, for example, is because a lot of investor activity is concentrated there. So what we do know is that we do have buyers out there, and that we're still at sort of a national supply issue, even if different markets have their own dynamics, but that in general, the buyer activity is still very strong. There's desire there, and anything to sort of implement a change in perspective among people who could be out there and looking, such as a rate cut, will certainly bring activity into the market. And it's something that we've seen from Domain in the past week, who said, economists there said they do anticipate seeing prices continue to rise over 2025. That, if you look at the capital cities in general, just taking them all together, lumping them all together, house prices did rise by 0.8% in the September quarter and 7.8% year on year. That is substantial. Despite this, though, growth is 3 times slower than the previous quarter. So we're seeing that sort of tempering activity. And a lot of that is, in part because of this surge of listings that we're seeing coming out this spring. So really things individual markets are running at their own speed, but particularly when it comes to sort of investor appetite and people being able to sort of move between cities depending on what they feel to be more hospitable, we do know that that's out there and it's still continuing to happen, and that will drive some of the price activity next year for sure.
So one thing I find interesting about these data, it says that across capital cities, house prices have nevertheless risen by 0.8% in the September quarter. So this was meant to be a quite a slow quarter, still went up. So there's a basis for saying, well, we're not necessarily going backwards. Say we're in a housing boom, the boom's not over, because more often than not, in more cities than not, they are at historic highs. One thing I will say though, is that this represents a 7.8% year-on-year growth. I think this demonstrates why shows like the Smart Property Investment Show are so important, because you've got investors out there, 7.8% year-on-year growth. You've got investors out there that are performing worse. Their property portfolios are performing worse than if you covered up your eyes and you put a couple of stocks on a dartboard, you covered your eyes, you threw a dart, and you invested randomly from where your darts land. That would perform better than the average property portfolio with this 7.8% year-on-year return. So it is slowing down a little bit, and it represents, well, you can't just go out and acquire houses. You can't go out and acquire apartments and flats for the sake of acquisition, because there are clearly a lot of areas here that are performing worse than you would expect from what you're reading in the headlines.
Yeah, and it's interesting, because obviously, as we're talking about, each city is sort of telling its own story. So there is certainly an argument at the moment for counter-cyclical investing in Melbourne, which is now the second most affordable capital in Australia. I believe I have that correct. It's fallen from the second to the sixth most expensive. So it's hard to make any kind of sort of statement on how things are performing for investors based on the national figures, because things are running at such a different speed. And Melbourne is certainly one.
Looking at the Melbourne market, why is that? Why has it dropped?
Melbourne is very interesting. And we were talking this week about whether Melbourne represents, certainly with those Sydney figures coming out too, is Melbourne ahead of the curve? Is that what is going to be happening across the capitals? And the consensus really is that no, something quite unique is happening in Melbourne, which is that this is a city that did actually keep pace with supply for about 10 years, particularly in the apartment market. And that is now having an impact on the growth that it's now having an impact on its growth in prices, in that it's not what we're seeing is it's not growing at the level that many other dwellings across Australia.
Their supply is simply over meeting demand. And you can see that when you walk around Docklands, right near Melbourne CBD, like a 15, 20-minute walk from the CBD, quicker, there's a tram right there that you can jump on. And you walk around, there's actually no one there. And you've got high rises, and I've actually stayed in them. A lot of them are Airbnbs. And to be clear, they're very beautiful. They're very well done. Inside, they're immaculate. They're very well laid out. But there's really not that many people there. I think another factor, which I'm not sure whether people that you speak to, Juliet, in property reflect this, but the layout of the city is a lot simpler for the urban expansion. It lends itself a lot better to urban expansion than Sydney does, where in Sydney you have the economic hub really only a few kilometres from the coast, and then the sprawl flows just out west, north, even south. It's bounded by a national park, so you can't expand south that far. So what it does is you do have intense bidding wars in the areas immediately surrounding the CBD. Unlike Melbourne, where the ease of transportation in a city surrounded by urban areas and living areas means that you could be, quote unquote, out in the suburbs, but like 20 minutes from the CBD, which is not something that you would have in Sydney, where even for yourself, Juliet, 50 minutes door to door, but as the crow flies, you're probably only a couple of kilometres from the office.
Yeah, absolutely. It's true. And we've talked about that. My old commute was quite brutal. Thanks to some new rapid urban infrastructure, the metro, I have cut down on that commute, and it's been life changing. But it does go to show, exactly to your point, that infrastructure makes a material difference. And when people feel they can get that lifestyle that perhaps they're seeking, with yards, with space, and still make it into an inner city pretty quickly for their jobs or for whatever reason they have to be there, they are choosing that, and they're not necessarily going into that density in the way that we are seeing in other cities. And, I think it's something to note that people are urging real patience in Melbourne. And that's why we do talk about it as a potential for countercyclical investing, because, as they say, Australia's capital city property markets do generally tend to return to relative normalcy. Just because we're not seeing the level of growth in Melbourne that we're seeing in other cities doesn't mean that those investments are things that are mistakes for people or something like that. And we're always talking on the SPI show about the long-term plan. So it's a bit of a waiting game in Melbourne, particularly, and it's something that people were saying for those who had bought in Perth during that boom and hadn't seen property values come back up until very recently, this
That is
last
a
year.
recent phenomenon.
And that's where everybody wants to be. So it's about playing the long game, making your good strategic plans, as we're always talking about on this show, and really having some foresight to understand what the long-term game is there.
It really feels like it was only, it probably was only a few years ago where people were so frightened of the Perth market, given the reliance on the commodity sector, given its reliance on resources, and seeing how many townships in WA would almost routinely collapse in property prices, that investing in property in Perth was seen as too speculative, that even a lot of seasoned property investors put that down to that is too risky for me basket. And that narrative is completely gone. There is no supply there to meet the demand. I've got friends out in Perth that are buying at the moment, and houses are on the market for what seems like seconds. So it is a state of change. We're going to go to a quick break, and when we're back, we're going to be discussing the changes in the rental market and some recent legislation brought out in Victoria and New South Wales. We'll be back in just a second. Well, good day, everyone. Liam, Garman, Juliet Helmke here, the team behind the Smart Property Investment Show and Smart Property Investment at Momentum Media. And for those of you who joined us just before the break, we were unpacking some interesting data coming out around Sydney and Melbourne's property market. And is it going backwards? Is the boom over? Well, unfortunately, crazy things have happened. So we're not here to infer. We're not here to cast judgments on it, because
we just bring you the data.
We bring you the data. And you know what? I'm so worried about someone coming up to me in 2 years with that 30-second recording. Hey, you said this and being proven wrong. So I'm not going to make any inferences. But we have seen a fair few legislative changes in the Victorian and the New South Wales rental market. Juliet, look, they're very similar, the changes that have come through. At a broad stroke, what are we seeing?
Okay, well, one big thing that we have seen, which was a long time in the works, is New South Wales has passed a ban on no grounds evictions. And it's something that major parties going into the last election had both united to say that they thought it was a good move. So we knew that it was going to be in the works for quite a while. There were a little bit of delays on bringing that legislation into Parliament, but it has now successfully moved through those phases. It's passed Parliament. And so what we have is a coming ban on no grounds evictions. It has not come into practice yet. There are still the legislation still needs to be put into practice to make sure that can go forward, and that is expected to happen very early next year. But so what that will mean is that landlords need to have a reasonable excuse for issuing an eviction notice to a tenant in New South Wales. There's a whole host of reasons that people have there that are very reasonable. Damage to the property, breaching their contract. You can't do something that it says in your lease agreement that you're not able to do. If the property owner wants to do extensive renovations, if they want to sell it, if they want to move in, if they want a family member to move in, all of those sort of things are contained within this. And so that is a change that will be coming into New South Wales. Now in Victoria, what we've seen is the state saying it is going to move to do the same thing. And so while The legislation has not been introduced yet. It was a big announcement by the Victorian government saying that they want to bring in what they're calling no-fault eviction. So it's the same. Everybody uses their own language. New South Wales, we say no grounds. Victoria is calling it no fault, but it's very similar. And that's what we've been seeing happening in a number of other states as well that have sort of moved towards this type of legislation.
It seems to balance out the ethics of it quite well, that you do have the ability to break the lease with those within reason, provided that or the tenants are breaching the agreement, or if there's damage, or if you need to take up occupancy as the owner, you still have the ability to flex those laws. It seems like a very fair balance.
Yeah, I mean, look, that there are a lot of different perspectives on it. Basically, what most governments come out and say around this is that they don't want to see evictions happening purely based on price, based on the idea that were a new tenant to be brought into the property, that price could be elevated. And I think there's a real argument for it in today's current climate where rentals are very tight. That's a whole lot of stress that people are undergoing to have to, rapidly change through to different properties. But there, of course, are a lot of economic considerations from the other side of things. So, yeah, I think it appears to be a striving to get a balance between these two sort of dynamics of making sure that we have a thriving and active rental market. And that's something that allows people to feel like they can sort of live in their homes while also supports the investing community. We don't need to preach to the choir here of how important that is, but because these legislative changes do need to ensure that investors are supportive because they provide so much of the accommodation that exists in that market. But so what we've seen in Victoria is that they are making a move towards that. And they are also proposing some other changes. So limiting, for example, the fees that tenants could be charged for breaking the lease. And they haven't said exactly how they want to do that, but basically making so that a tenant isn't paying more than 4 weeks of rent for having to break a lease before that was due. And also bringing in a law to sort of ban charges being imposed on tenants for paying their rent. So while the state currently says there must be a fee-free way of paying your rent, they believe that some of those methods that have been put forward, such as, you must go and pay it in person at a post office, are sort of still imposing too much on tenants to need to go and do that to access the fee-free way. So that's what they've been looking to bring in, is saying that all rents must be able to be paid without being charged. So it's some interesting things there. We will be tracking how this goes because, of course, there will be a lot of consultation with stakeholders as they move towards introducing those legislative changes.
I'm not seeing anything here that's particularly worrying at all. It all seems pretty reasonable.
Yeah, I think, REIV, Real Estate Institute of Victoria, this week have flagged some things that they would like to be a part of the conversation on. Particularly in Victoria, rentals are quite tight. And we know that taxes have been very high on investors there, particularly for the state to try to recoup some of the COVID costs that were unrelated to investors, but they are now being charged with. So I think one of the clear messages coming from, the advocacy bodies is that people need certainty. They need things to not be a, constant regulatory change because it sows confusion and it's hard for people who provide rental properties to stay on top of them all and can kind of disincentivize them from participating in that way. So we will be certainly keeping a keen eye on it as that all progresses.
Watch this space. We're going to go to a quick break, and when we're back, we're going to be unpacking the world of inflation following some very interesting data released by the government, and we'll be back in just a second. Liam Garman and Juliet Helmke here, the team behind the Smart Property Investment Show. And just before the break, we were unpacking some rental reforms in Victoria and New South Wales. But looking at it, it all seems very reasonable. I don't see there being any reason to panic. But turning the discussion to inflation and a little bit of a backstory to this and why I thought it was quite an important topic to have a bit of a monologue on was after the government's recent inflation figures. It was last week when we were looking at, inflation's dropping, the cost of a basket of goods is dropping. And I was, okay, that's interesting. And I was looking through Australia's bond markets and I saw that our long-term bond yields are still very high, which kind of raised a few questions in my mind. If they're still high, if yields are still high, that means markets and quite informed investors are still baking in long-term inflation and long-term higher interest rates into their investment decisions, which seems quite at odds with what a lot of investors are expecting. We've seen a lot of Australia's major financial institutions and investors themselves come out saying we project rate cuts maybe in December, maybe early to mid next year, though the bond market doesn't really factor that in whatsoever. So I did a little bit more digging. I came across a very interesting take from Master Builders Australia, which looked at the inflation figures, and it found that things like energy rebates, rental assistance measures have artificially decreased the cost of goods, the cost of a basket of goods for the Australian punter. Because their cost of a basket of goods has decreased, therefore the rate of inflation has been artificially decreased, though those underlying cost drivers, your house prices, house price increases, your rental increases, are still growing. They're still going up. And looking at underlying inflation, it's still sitting at that mid 3% mark, that 3.5, 3.8% mark, which is pretty much that 1% above where the RBA needs to be. So obviously the RBA needs to have inflation between 2 to 3% and low levels of unemployment. Between 2 to 3%, typically in RBA parlance, would aim to be 2.5%. So we're still 1%, if not more, above where the RBA wants to be in inflation. So despite rhetoric from the government that inflation is going down, it is holding quite high. Hence the bond yields not indicating any future decreases to interest rates. Now, why is this the case? I think it's very reasonable at this point, given feedback from RBA board members. They've been pretty vocal with it. A lot of them have come out, former board members as well, have come out saying, well, government demand or government expenditure is artificially driving demand, which is pushing it up. So we're like, often on the Smart Property Investment Show, we focus on the supply side, increasing more dwellings to drive the price out. But obviously, you've got to look at the demand side as well. That if basically all of Australia's economic growth over the last 12 months has come from increased government expenditure, that is artificially driving demand as well, which is a key driver of inflation. We've seen RBA board members come out saying that. We've seen some of the big four and financial institutions coming out saying that it is a demand-driven phenomenon. This is my opinion. I will prefix it with that. But I think the inflation problem is here to stay. And I think looking at our level of inflation, I can't see interest rate cuts on the horizon, especially what we're looking at now. We're on the eve. This is going to come out about 24 to 48 hours before a US election. And looking at the party well, we don't say party manifestos in the US. That's a very UK terminology. But looking at the policies of both candidates in the US, I think it's 7 to 8%. President Kamala, under her expenditure, will increase inflation by increase the government deficit by 7%, and a President Trump will increase it by 8%. A fraction of difference between the two, but both of them will drive inflation in the United States. We have had now the UK government come out with a $28 billion windfall, unfunded promises coming out, £28 billion a year in unfunded promises. Markets over there, again, the British bond market has, from the Bank of England, has just gone up. Yields have gone up. So we're factoring in for future inflation in the United States. We're factoring in for future inflation in the United Kingdom. The Australian bond market is factoring in long-term inflation. I don't see there being much help on the horizon. That's just what the data's saying. That's what the political environment's saying. I hope I am wrong, and I hope for some reprieve soon. Juliet, am I being too much of a pessimist?
Well, I don't know there. Look, we've seen a lot of differing opinions come out after the latest CPI data. We certainly saw the Real Estate Institute of Australia say it's good news. You know, it's not immediate changes by any means, but the fact that, you know, we are sitting within that band, that's it should be good news to anyone, whether or not you're hoping for your mortgage payments to go down, just to see that there is some moderation. And I think that there's a difference between that moderating rises that we saw that were really, quite damaging to the economy, and those high levels of consumer price index. There's really a difference between those high level of inflation, those inflation being pushed up, quarter over quarter, and a moderating rise, which is what we want to say. But it does not exactly, as you're saying, Liam, mean that relief is immediately in sight. It does not mean that, everything's fine and things are coming down. Inflation has long been thought of as a beast that we are going to need to learn how to live with to a certain extent. And so that may not be welcome news for borrowers for whom, all of this conversation revolves around what is the bottom line for me on my mortgage payment. But at the end of the day, we do want a healthy economy, and we, because that benefits our society. And so it's weighing those things up, I think, and understanding, is there some optimism potentially in this news? Yes. We've seen the REI say, look, it's good to see figures like this coming in, but does it mean that your bottom line is changing materially? That will very much be yet to be determined.
Now, if anyone has any complaints, if anyone wants to go toe to toe with me on the inflation line, if there's anyone out there listening that says, no, I'm banking on it, I'm banking on an interest rate cut, and you want to go toe to toe with me on a Smart Property Investment Show podcast, please send an email to liam.garman, Garman, not like the GPS, not like the watch, at momentummedia.com.au. Let's go toe to toe. Let's unpack this. It's for the benefit of the property investment community. We want everyone in our community to be well informed. We want everyone in our community to have the economic data and the knowledge at hand to make informed investments to give them long-term financial stability. That's what we're all here for. We are a community, and we do need to make sure that we have the best knowledge at hand to make those informed decisions. But that is all we have time for today. Thank you so much for joining us on the Smart Property Investment Show podcast, and we'll be back at the same time very shortly. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Feeling trapped by rising interest payments? Escape from mortgage prison with expert refinancing assistance from Finny. We have helped hundreds of borrowers break free from higher loan repayments by finding a more suitable loan. Our expert team can quickly assess your situation, and if there's a better lender available, we'll find it fast. Don't delay. Call today. Speak to a Finny mortgage specialist on 02 8866 2444 or visit our website at www.finny.com.au.